Good day, everyone, and welcome to summer webinars with optimizing risk to reward. And today we will show you key tips for trading plan and summer trading part 2. And I will start first with explanations of two possible methods that you can use to trade lower summer volatility. Of course, if you follow our analysis, you know that, and live trading webinars, you know that both Chris and I went long on euro dollar. We were long, and definitely uh, the price from yesterday live trading webinar came into very, very good profits. I mean, it was this day today was excellent one. First euro dollar, then pound yen. I mean, it was like, as Angel is saying, it was a perfect day. So we wish to tell you that you bring your friends, family, trading buddies, boyfriends, girlfriends, everyone to our trading webinars, because this is what we do. We are teaching you how to trade properly because we are traders too. And Angel is saying on gold. Indeed. I mean, a big movements. Really, I like this volatility, but still, you need to know that summer trading is not that volatile. Most of the time, you will be seeing volatility when some news let's say, when some news is released, or when some rumor is going live. Like for example, if a head of central bank says something, it can be just a rumor, not a fact, and usually that can be a big movement in the market. But still, as you know, guys, we trade what we see. So summer trading, if you want to be a little bit calmer, then you should find markets that are calmer. And this is what we are going to show you today. Before we start, as always, this is me, this is Chris, and our disclaimer explaining that CFD and Forex trading are leveraged products and can result in losses that exceed your deposits, so those are not suitable for everyone. And this presentation and the video is for informational and educational purposes only, and online materials are developed by the Markets Estonia for a global audience. And this video is not part of the .co.uk website, but the globalnews.com website. So please read the full risk disclosure on this web address. So today's agenda, summer trading tips number 2, and low volatility trading system. So we will see. We have a lot of things to do and to show you, but well, we will keep it, as I say, short, because I know that it's also 6 p.m. our time, and it's summer, so maybe some of you want to go out. So we will be very clear and concise. Okay. So today, naked camarilla trading and low ADX system. As you know, guys, I apply camarilla MACD method, but well, with this indicator that I will show you, of course, you might try to trade also, you might try to trade low volatility trading pairs. That can be very good when market is in the range. First of all, when we speak to naked camarilla trading, we need to say that it's basically pretty much very simple and concise. You need to have ATR indicator, and you need to have camarilla that Chris and I use. You can also have the free camarilla indicator from us. This one is a little bit modified, but also we are sharing free indicator. So you can, of course, send us an email, and we will send it for free. This indicator that we developed actually shows a little bit modified levels. It shows on 4-hour time frame. It shows W, H5, H4, H3, WL3, L4, and L5. Also, within these levels, we have a possible trading setups. Now, if you go into the indicators list for this indicator that we use, of course, as I say, the indicator that we share does not have all the options. Okay, it's a little bit stripped from all the options, but still you can do this. What I'm showing you now, you can show weekly time frame on H4. Now, why is it important to use camarilla, and why is it important to use weekly time frame of camarilla in the 4-hour time frame? First of all, it's the important thing because Admiral Markets platform currently works wonders with camarilla. Definitely, it's optimized for trading the camarillas simply because the closing time and the platform time of Admiral Markets corresponds to New York also close time. I think I haven't checked it, but I think that the server is located in Helsinki, and for us European traders and also US traders, including Canada, this is the way to go. This is great. So you don't need to use GMT shifts, all these kind of things. I mean, this is simply very, very good just if you use camarillas by themselves. So this is the indicator. Again, this is the indicator on 4-hour time frame, and you can see here easily. You can see my indicator settings here and different settings within the indicator itself. It's important to stress out that most of the time when I trade naked camarillas, let's say I use it mostly for scalps, but also I can from time to time make an occasional intraday trade or a scalp swing, depending of course on ATR. Now, the biggest problem within other schools and other, you might call it teaching universities and teaching mentors, is that no one mentions the ATR indicator. I mean, guys, it's pretty much simple. It's pretty much very clear when it comes to trading. When you see that the pair is making 85 pips, or let's say usually, I mean, this is now because of the news, 180, but usually, let's say it's like 79 pips, okay? Usually when that happens, guys, you need to know that this pair is very, very low range. But then if you go to GBP New Zealand, for example, you will see that the pair is making 161 pips for 14 days. Now, this is the trend, and this is a huge, huge ATR for a forex market pair in these conditions, because we have summer trading. Volatility is good, but it's still lower compared to other months. So why is it important to find lower volatility trading pair? Simply because it will give you more chance to trade the entry. For example, here, let's use this example. This is dollar CAD. This is pretty much very, very clear. We have a 4-hour here. You see, it touched our weekly L3. So what you do basically with these kinds of camarilla pivot points. It's important to know that the pivot points that I'm focused mostly when I trade naked is weekly H3 and weekly L3. When price hits, but it's important to say, it needs to come 10 pips at least away from the price or touch it. And then if it comes in the zone that is defined by 10 pip buffer, you either buy it or sell it. So it's important for you to understand that the concept of trading these camarillas is pretty much simple, because it's concept of naked trading. So here, if the price touches the level, then you go short. If price touches this level or 10 pips above it, you go long. So if the price is 25.65 here we have 25.78. Well, it's still discussable. You might try smaller entry and see where it goes. But here you can see the price touch the level. 25.65, now it's 25.90. You see it basically reached the zone, and you would have been like 20 pips in profit. Have in mind that if you want to trade during low volatility, you also, as we said in the previous webinar, you also want to lower your targets. So you don't want your targets to be big. Also follow the ATR and get, let's say, 20% of the ATR. So if this ATR is 95, 20% roughly is 19, 20 pips. Okay, it's very important. So weekly L3 camarilla is important. Weekly H3 camarilla is important. But also you can focus on monthly levels, because usually when price hits the level, it will react accordingly. But as I say, I personally am focused on weekly H3 and L3. This is the range. If the price breaks below the range or above the range, I don't trade the pair. I mean, I'm simply talking from the perspective of low volatility trading using naked camarillas. Okay, this is pretty much straightforward and simple. For example, here you see first we had this is when the price opened. This is weekly H3, weekly L3. 81 pips is okay, but we want to have even 50, 60 pips. Is the best when you have 50, 60 pips of ATR. The price level for this is 117.35. Price came within, okay, came within the buffer, and you see what happened. 50 pips. Guys, it's important to understand that the first touch is the most important. The first touch is the most important. When I see the first touch, I will trade it. Next touches or entries in the zone can still be good, but they can also go up and down like this. If this happens, get the profit as you can, and of course, exit the market. You don't want to, if you trade the first touch, it's important that you place your stop loss above the ATR. So if this was the entry, the ATR originally was here. So this is potentially good risk to reward. Don't make less than 20 pips of a stop loss, even if the ATR is within 10 or 15 pips. Don't make it less than 20 pips. Here another example, the price rejected, and you will find a lot of these examples. Here another example, Australian dollar, 4 hours, 66 pips is the range. So definitely this is a low volatility and low range pair. The ATR for me is the best volatility and range prediction indicator in the market. So definitely you can opt to use it. So here, as you can see, the price hit the buffer zone, rejected, and another rejection. I mean, pretty much straightforward. And I think this can be a very nice way of trading this low range. Also here, guys, as I say, weekly H3, weekly L3, weekly H4 rejections. As I say, if the price makes a trend, as it did with pound yen, I simply don't want to trade it. And of course, not just because of trend, but watch this, 121 pips. This strategy is suitable for low ATR. For trend trading, today we had excellent setup on pound yen. As I said, pound yen gave us a lot of profits. If you use the setup that I published on Admiral Markets here, you can see a pretty much very clear setup. And this is something else. This is Camarilla MACD, but this is what you can read every day and watch live trading webinars. But of course, this simply going with camarillas, as I show you in low range pairs, you might do good. 83 pips, not bad. The first touch was here, and you see rejections. 1, 2, 3, 4 rejections from weekly H3. The best is, of course, weekly H3 and weekly L3. Those three levels always are the best. Always are the best. Remember that. You can find a lot of pairs, but try, as I say, to find something that is very low. For example, let's see what this pair is telling us. Here, probably this would have been a stop loss, but yet again, here, this would have been a good entry, okay, because the first touch of, no, this would not be a loss. Wait, let me zoom in. Let me see what happened. No, this could have been probably a nice opportunity here, at least for 20 pips. So you see, even though if the price went, first it went up, then it dropped. Then it came to L4, rejected a lot of rejection. Important thing is to know that if you trade these naked camarillas, Do 1 or 2 trades per day. Don't overtrade because you're going against the market. The range is low, so you really need to take care of the range. Make 2 good trades and you are good to go. Next thing that I want to show you, and then Chris will continue, is so-called low ADX system. Very simple method based for low volatility. Low ADX system, long entries. ADX needs to be below 25. We need to have 3 consecutive lower closes. Then we buy on the third down close. Either we trade either 15 or 1 hour time frame. We exit on the close of the third bar after the entry. Stop loss is 15 or 20 pips on M15. Mostly I try this method on 15-minute time frame. ADX also lower than 25. We can have 3 consecutive up closes. We sell on the third up close. Time frame is 15 minutes or 1 hour. Exit on the close of the third bar after the entry, and 15 to 20 pips is the stop loss on M15, and this is how it looks on this chart. Let's use, for example, Australian dollar. So you need to put ADX 14. It's the indicator that you can, of course, find within the Admiral Markets platform. And here, when you double click it, you can safely remove plus DI and plus and minus DI line because they are not used in this system. Also here, 14 is the default. So you basically use the 14 period for the ADX indicator. It needs to go below 25 as I show here. So this is our trading range. So when the price makes 3 down closes, we buy. So 1, 2, 3, this is our buy opportunity. And 1, 2, 3, this can be an exit or you can exit here. Then 1, 2, 3, another lower low, 3 consecutive lows, and here 1, 2, 3. This is your exit here. 1, 2, 3, low, 1, 2, 3, up. You see, this is mostly scalping method. ECN account is recommended for this kind of trading because of the lower spreads, and still you can make 5 to 15 pips for one single trade. As soon as the ADX crosses 25, you don't trade this method anymore. You really need to have low ATR here, low ADX. Here you can see also ADX below 25, 1, 2, 3, you buy here. Here is your buy entry, okay, and watch where the price went. I mean, it's pretty much straightforward. 1, 2, 3, and here you sell. You see how the price rejected from this part. So this is very extreme, an extremely based scalping method, and I really advise you to use it first on demo account, and then you can go with a live account. If you don't understand the logic, you can always send an email to me, and I will tell you if you're wrong or you're right with rules. But as I say, this is really straightforward. You need to practice it on demo, and of course, try to use low ATR targets. Also, what is important is to say that for summer, you need to lower your targets, especially if you go with low volatility pairs, as I showed you, of 50 or 60 pips. Less liquidity means less direction of flow. ATR will decrease on most of the pairs, so try to go for 10 or 20% of the ATR value. The big problem with trading the low summer volatility can be a trend if you use range bound systems. Because of that, you really need to think how you would handle some trades that require you to be on the safe side of the market, which is trending. So that is why I'm not recommending pound yen for these trades. All trending pairs, just find range bound pairs with low ATR. Let's say ideal ATR is 50, 60 pips, but up to 80, 80, 90 maximum is the way to go, not above it, okay? So as I say, ideal is to find something that is 50 or 60 pips, such as, let's say, Australian dollar. So this was my part. I hope that you enjoyed. Regarding Camarilla, just send me an email, and of course we will explain everything and send you the free email, the free Camarilla indicator if you want it. So Chris can continue now, and don't forget, if you have any questions, feel free to ask me.
Thank you so much, Nenad. Great stuff. Let me share my screen first of all. There we go. You should be seeing some slides now finally. There we go. So summer trading, indeed. Here's some thoughts from myself regarding the summer trading. Volatility could be a tad less when we go into August, first few weeks in August specifically. So one thing we could do, for instance, as always, take a look at the trend. Is the currency pair trending? If it's ranging, of course, it could be something to consider, maybe to avoid, or if you like range trading, you can focus on that. That does depend on how you trade. But I like to trade with the trend, so if it is not trending, that's something I would avoid. I would try to tackle the trend like this. This is just an example. There are multiple ways of doing that, but let's use this for this particular system. So long-term trading moving average gives the overall trend, 144 EMA. You can see is this lower line. Short-term moving average is kind of the confirmation. When the short-term moving averages are above the long-term, it's an uptrend. If they're below, it's in a downtrend. Of course, in this example, it's an uptrend. Here we have a double moving average for the short term. So you can play around with moving averages in many ways. This is one of them. It's like a double moving average. It's kind of like an alligator in a way, but just using EMAs. And they're quite close to each other, right? It's an 8 and a 21 EMA. So that's why you see them relatively close to each other. But when price does show strong strength, then we see them pulling apart away from each other. Also, we also see the fact that they are aligned, which also gives a kind of an extra confirmation of the trend. So this is the setup for seeing if there's a trend available. Obviously, we want these three to be aligned. All right, so with summer trading, could be a good idea to, for instance, as Ned already mentioned actually in this last part, that adding the ADX, good for momentum, just like the ATR, also an option from this point of view. But ADX, definitely used by many traders, good traders, they love using ADX. So it's definitely a tool you want to think about. Here in this screenshot, using 14. But basically, if you don't know ADX, it's just a good way of measuring kind of the movement, how much price action, volatility is available. And basically, the higher it is, the more movement is made, the lower the least or less movement has been recently made. So I use levels between 20 and 25. If it's between 20 and 25 or above it, typically that's pretty good. If it's below, then it's a bit on the slower side. So Nenad was showing something that was good for slow. I want to see something more. I want to see above. So I want to see basically price either at or just above that zone, right? Or above it, clearly above it. That's basically kind of a filter. So if it drops below it, then you might want to be careful with this particular currency pair or instrument because the volatility is dropping and price may not have the punch left in it. Especially when we go into August, might be slow, price might be going a bit sideways. I mean, it's not that bad. It's not as much as you can see sometimes on the 24th of December. But yes, typically goes a bit down on average. If you look at several years, you look at August, then yes, you'll see it. So if you use this to kind of defend yourself against that, it's also good to look at the angle of the ADX because if it's upward, that means growing volatility. If it's downward, decreasing volatility. All right, the next thing is the CCI for pullbacks within the trend once we have a green light from ADX. The CCI I'm using here is value 6. It's good for retracements, short term, so you kind of see the pullbacks, the dips within the trend. And the angle change is an early entry, aggressive entry, as soon as the CCI heads back down for shorts or up for longs. In this case, longs would be up, would be here, for instance, right here. As soon as this goes up, an entry can be made right there. I know it's very small. Hang there with me because I'll take a look at larger live charts in just a second. But as soon as it turns up, that is the entry, that is the angle change that indicates that the dip is completed. So you got three things here. You have trend, retracements, and continuations. The trend is based on moving average. The pullback, the continuation, is based on CCI, and the ADX is kind of a summer element where there's sufficient volatility, because if price is in the range, there's no volatility, then these small pullbacks with the CCI are not going to save us or help us. So let's take a look at the live euro dollar chart, and then it mentioned it already. Of course, the interest rate decision is always an unknown factor, and hence difficult to kind of trade in a way because of the fact that you have an interest rate that could send price in all directions. But our analysis, yes, was bullish. Not everyone, apparently that was telling me that there were, some traders that were bearish. We were personally bullish indeed, and we got the bounce. I think I was using a different fib yesterday though. I think I was using this one. So if you use the whole leg, it was 50. This was the 61.8 fib. Both cases, this particular fib levels, were used. So that's good. It doesn't really matter. This one is a 50. This one is a 61.8. So both were respected. Both were used, and price indeed continuing today. This particular continuation, though, yes, was a bit more volatile, slow, and then volatile. That's because of the reaction to the news event. There's nothing we can do about that. That's just how the market works. But the technicals, from my perspective, did prevail and follow the plan that I think was logical when looking at waves and technicals. So that's good. Now, regarding this particular system, let me zoom in here a bit and take a look. We are looking for an uptrend. So let me make this a bit smaller because there we go. All right. So we need an uptrend, and the uptrend starts here. So the first potential setup was here, where it snaps back, which is this part right here. So that's the setup. It is a falling ADX. It's not a rising one. So from that perspective, it's, we want to be using a relatively not so tight stop loss. So we'd have to use this bottom. Price makes a retracement a bit deeper. There's another setup as the CCI snaps back on this bar right here. That could be another one on this one, and up it goes. Right. So those are two potential entries. Let's see. Here we have, by the way, with CCI, we want it to go below the minus 100 or above the plus 100. All right. So this one just qualifies. So this is an entry too. We get an uptrend. ADX is above it, and we have a snapback and turn. Let's see. Here we have another one on this candle. All right. And that's it. Here we don't, because the moving averages are turned to the downside. So pretty straightforward. Of course, we can combine it. We could use the hourly chart for trend and say, okay, this is an uptrend, and then dive into the 50-minute chart to look for actual entries. That's also possible. You can use multiple time frames as well, of course, to tackle the market in this particular method. This is just an entry system. It is not compensating analysis. I would not use it as a pure trigger system. I'm not a big fan of trigger systems in general. I like analysis and then zooming in to look for triggers. This is one of those methods that can be used to look for triggers, but it doesn't replace analysis. The analysis is always step one. So how about this downside? This downside is not with the trend because although the short-term moving averages are bearish, it's still above the long-term moving average. So these are not, even though the ADX could be aligned, even though the CCI might pop back, this is not. This is basically a retracement back to the long-term moving average. So those don't count. We want to have everything aligned and trade away from those moving averages. That is the most solid, and that is basically the most secure for trend trading. It's a good way to start trading as a beginner or intermediate. Trend trading is not necessarily easy, but it is better for beginners than reversals because reversals are complex, they're more rare, and they can turn into retracements very easily, and then the trend might still continue. So they're full of traps. You can step easily in one of the traps, and trend trading, you have the flow on your side, so it's much easier. It's the same like swimming with the flow. If you're swimming in the river and there's a tide, or there's not a tide, but there's the stream, there's this current, right? So try swimming with it or against it. So reversal trading is swimming against it. You have to be much more precise. Swimming with the tide or with the current is trading with the trend. All right, so this is not a setup because it didn't go into the oversold CCI box here. All right, nor is this a setup. Wait, no, sorry. Let's see if I can find an example. The ADX on the euro dollar has been pretty good. I'm looking for an example of the euro dollar ADX, but it's been pretty sturdy and stable above that level. So it hasn't really dipped to below that 25 all too much, in fact. So I can't find the example where the ADX is kind of handy in filtering out something. Perhaps here it dips below the zero, but not the best example. So, but you know, ADX, euro dollar has been moving quite well, as you can see. So in this case, the ADX is not much of value, but on certain pairs with lower volatility, you will see the difference. All right, so can't find a good example here, but so what are dips? Dips here, dips here, dip here. Let's see, and a dip here, right? Dip here and dip here, and basically this setup here, the first three were fine. This one not, because you can see that price retraced deeper, and an entry on this candle right here, or this candle, right? 45 or 75 pip stop loss would probably have been taken out by this small little wick. So that could have been one loss. And that's not surprising, of course, because those things happen. So that's not so strange. So here we see another one. Now this is an example where putting the stop loss below this bottom is a bit annoying because we're looking at 100 plus 100 stop loss. So that's a bit wide. So is this a setup that could be skipped because it's such a big risk? Yeah, of course. It's just a potential trigger, obviously. And that, those things happen. So this is an example where price has moved so much that we might want to be careful with these kind of setups. Let's see if we can find a few more examples. One more example, perhaps. Any questions? Let me take a look at ADX so we can find some examples of ADX, because I don't think we went through that too much. So last one. Sorry, let me quickly add the moving average, a long-term one. All right, so we are looking for here. Here we can see, for instance, downtrend, CCI spiking, downtrend available, but the ADX is below the 0. So that's something, below the 20. So that's something we would avoid. We would avoid this particular part, right in here. All of this, or most of it, should be avoided just by looking at the ADX. So that's a clear example with using ADX. All right, so it's simple. Once again, don't skip analysis because of it, but it's good for triggers. It's good, like if you have found a pair that you like to trade and you want to trade in a certain direction, but you're looking for potential setups within the trend, then it's a good way to avoid choppiness. But then again, if it is trending, to find those dips and turns. So one way of summer trading, we're going to have summer trading webinars, basically one more. We're going to take a look 2 weeks from now. In fact, next week we'll have something of a different topic in between, but I think in beginning of August it should be one more on this topic. So hopefully see you then. We got more webinars, of course, not only on Thursdays. You can find out education, go to Forex and CFD webinars with admiralmarkets.com. And there you'll find a ton of information. I hope it will not be too much, and you'll be able to check it all out. We got courses here, articles, daily analytics, technical and wave, and fundamental. And of course, if you're interested in some of these indicators, special indicators that we talk about in the webinars, like Admiral Keltner, you can find that out right here. Check it out, MT4 Supreme Edition. And that's just, a couple of those indicators that we use in the trading room webinars. And you'll find out a lot more, 60 extra features actually in this package. So, all right, that wraps it up. I thank everyone for joining and see y'all very soon. Cheers.